All right, let's you know what? Let's do the gem first, and then we'll do the pitch, and then we'll do the pitch, and we'll banter a little bit, and then Emma will be coming probably around 8ish. But David Griscom, take it away.
Yeah, so this actually flows pretty well when you talk about the dangers of a reformist agenda. So one of the main activities that aggravated and led to the financial crisis in 2008 is set to return to its pre-crisis level of deregulation, thanks to our Republican friends in the Trump administration. So the largest U.S. banks have been ramping up their lobbying efforts to repeal a post-financial crisis rule that required large lenders, who because of their size are crucial, absolutely, they're crucial to maintaining our financial system. Basically, they want to repeal a rule that forces them to set aside cash to cover themselves in case their derivative trading within their own affiliated banks goes bad. So basically, this is what happened in the financial crisis, where banks were moving around derivatives that were based on mortgages, and they were bundling them up and moving them from bank to bank. And then when they started to realize that the underlying assets were bad and were toxic, nobody wanted to to accept them or to trade them. So basically, you just had this huge credit crunch, and essentially most banks stopped lending to one another. So this rule, which was put in place, I believe, in 2015, requires banks to cushion their derivative trading with their affiliates, basically saying if you want to make a trade with one of your affiliate banks, you need to have so much cash that you just put aside to cover your losses in case your derivative trading goes bad. So affiliate banks, just for people who don't know, are banks that a major bank has a 50% share in or more. So these are basically, smaller banks, international banks, and because of the centralization of the global finance system, it's a pretty large group that we're talking about here. So this is a significant rule change because with this rule being gotten rid of, it exposes so many banks to one, opening themselves up to another kind of asset crunch or a crisis, and also exposes our entire financial system to all of the repercussions in case that there is a loss in these asset values. So the lobbyists for these major banks argue, and this is a quote from the Wall Street Journal, that they want to do this to centralize risk internally without increasing a firm's overall exposure to risk. But what they really want to do is they want to have derivatives that they're holding in banks overseas,
right?
So not in the United States, and they want to bring those to the United States because then they'll be covered by the FDIC, basically meaning if they go bad, that's exactly right, that we'll be paying, that the federal government will be paying for their...
Publicize the losses. It's a great system.
Absolutely.
It's a beauty.
And we're seeing exactly what happened when we're talking about this mild milquetoast regulatory apparatus that we try to put in place following the financial crisis. Is just being chipped away at by the Trump administration and all these Republican lawmakers. And this is a story that's not necessarily going to grab the headlines, right? Because it's a little complicated and confusing to follow, but it's absolutely significant because since the beginning of 2019, the banks have really started to chip away at a lot of these smaller rules. So, people are estimating that this represents only about $40 billion worth of trading, which is a lot of money. Yeah. Don't get me wrong. But we're seeing over and over again that the regulatory apparatus that was put into place following the financial crisis is being blown out completely.
What's the Marxist answer to this? This is the dynamic we always see, right?
Absolutely. This is what Rosa Luxemburg talked about. Whenever you're pushing up, whenever you're pushing all these reforms, there's always a chance that the ball just comes right back down and crushes them until we fundamentally change our economic system and our banking system, this is why what Bernie Sanders is talking about with AOC is so important, right? Moving the majority of people's money outside of these small groups that have continued to grow.
That is a form of decommodification.
If
you have the option to get out of this predatory system and go to your post office, I'd use it. Mm-hmm. Period.
Absolutely. And it's a chance so that we're not so tied to the financial health of organizations that want to engage in very, very risky behavior and want us to cover their losses because they're so fundamental to the U.S. credit and financial system, which they currently are. Right. So we'll see what happens with this. The FDIC initially was not interested, but recently a statement, this is a quote from the chairman of the FDIC, said, "It is one of the things that's on the to-do list." And this rule change would also have to be passed, approved by the Fed. And Jerome Powell, the Fed chair, just said, "We are looking at the inter-affiliate margin question." So there's been a lot of movement that's been going on behind the scenes over the past couple of months on this question. And it's something that we should definitely be paying attention to and being a little bit worried about.
Excellent. David Griscom, Economic Minute. I think that should be his new thing. Yeah. Gets to the point. That's what we're talking about. You've just watched a Michael Brooks show video, and you can watch all of our full main live shows every Tuesday night at around 7 p.m. Eastern Time, and subscribe to get all of the clips you want. We're covering the globe. We're focusing on international relations, the intellectual dark web. We're having fun. We're doing deep dives with a lot of amazing guests. Of course, become a patron for the whole thing at patreon.com/TMBS, or subscribe to this YouTube channel and help us keep growing and get that content out there. Subscribe below.